Free cash flows to the firm. Let's review the formula for calculating free cash flow to the firm. This can also be referred to as unlevered free cash flow, and it's the cash flow that's available to all investors in the business, both debt and equity. The most common starting point is EBIT, earnings before interest and taxes. The reason is that this is the lowest point on the income statement before interest is deducted, and we want that point because we're not going to deduct interest, but then what we're going to do is multiply EBIT by 1 minus the tax rate to calculate what the tax bill would be if this company had no interest expense because it had no debt. So this tax bill is a hypothetical tax rate, assuming the company had no interest. So we deduct this new tax bill from EBIT. That essentially gives us our net operating profit after taxes, sometimes called NOPAT. Then we need to adjust it though for non-cash expenses like depreciation and amortization. As you'll recall from earlier courses, these are expenses that accountants create that do not necessarily involve any cash flow, so we add them back because they're non-cash. Other examples could include stock-based compensation or unrealized gains and losses. Next, we need to adjust for changes in working capital. If net working capital increases, that means a company's cash balance has actually decreased. If a company's working capital decreases, the cash balance is increased. This is the working capital principle, as we've covered in other courses. And finally, since we've added back the non-cash expense of depreciation and amortization, the flip side of that is that we have to deduct capital expenditures. Capital expenditures are the actual cash that's invested in property, plant, and equipment, which later becomes depreciation and amortization. So what we're doing here is we're essentially undoing all the work the accountants have done and getting to just the true cash inflows and cash outflows of a business. Finally, we get the unlevered free cash flow, or the free cash flow to the firm. This is what we use to value the company for the forecast period. For the terminal value, we may use the free cash flow to the firm and grow it with a perpetual growth rate, or more likely, we'll use an exit multiple and assume the business is sold. Now let's look at a diagram to see what the drivers of free cash flow are. So here are some drivers, and you can see that revenue, margins, taxes, working capital, and CapEx all combine to give us two components that then result in the free cash flow to the firm. So EBIT times 1 minus the tax rate gives us net operating profit after taxes, as we just reviewed, and then we adjust for working capital and capital expenditures, which results in cash flow. But let's go all the way back to the forecast drivers on the left here. We need to factor in things that we did in our previous analysis. You'll recall from things like Porter's 5 forces, PEST, strategic advantage, competitive advantage, management team, all of these kind of things. These are what impact the drivers. So we have things like market size and market share, sales and product mix, the pricing power of the business, the material price inputs affected by macroeconomic impacts, staffing levels, wage rates, etc., tax structures from governments. Then we have things like accounts receivable, accounts payable terms that may fluctuate. Things like the plant life for property, plant, and equipment, factories, trucks, machinery, etc. The maintenance that's required to maintain them, and the investments that are required to scale them up. So as you can see, there are a whole host of forecast drivers, and we need to make assumptions for each of them. They then flow through the diagram from left to right, and finally result in the free cash flow on the far right of this diagram here, which is what really drives our model. We'll be looking at an example of this together in Excel shortly.